Good afternoon and welcome to the 2023 Endeavor Bancorp annual shareholder meeting. It's Julie, you're going to tell us the time. Julie is the timekeeper. She's going to be calling out the time. I'm sorry? 6:11 on May 25th, 2023, and this meeting is called to order. I'm the acting chairman. I'm Steve Septon, the president of the bank. And Jessica Lucerno from ComputerShare is attending virtually on the phone from the East Coast. She's our inspector of elections. She's what makes this official. So these are our board members. But before I get there, there's a special board member emeritus that I'd like to recognize. Joyce, you want to stand? Joyce Glazer. Can we give a round of applause? Yes, thank you. Joyce was here. You can be seated. Joyce was here from the very beginning, before the beginning, and she did all the hard work with all of us to organize the bank, get it going, and brought us all the way up until last year before she retired. And we just want to say thank you for all your hard work, Joyce. So that brings us to this slide. In case you can't read it, I think it's big enough for you to do that. But Julie Dubik, Jim Ledwith, Brian Min, Jillian Murish, Matt Ratner, Dan Yates, Chris Woolley, Vicki Turner, myself, Steve Septon, and Lauren Polgar. This is your slate of directors that are up for election. I'm not going to come back to all of these names, so you're going to have to memorize it. But I'm going to ask these board members to stand. I don't think I told them I was going to do that to them. Go ahead and stand, board members, so everybody can get a look. Yes, you can go ahead and applaud. Stay standing, because we're going to now... You need to introduce yourself or talk to these folks during the social hour, but stay standing because now I'm going to ask all the Endeavor Bank team that are here to stand too. Endeavor team, stand up. I didn't tell them I was doing that either. So this is the whole team that's attending, not the whole team, but the team that's attending. You can be seated. We have another special guest, Kurt. You don't have to stand, but you can wave. Kurt Kicklighter, he doesn't want to be acknowledged. He's right here, everybody, our lawyer, our general counsel. And Era Villafana, she is not with us today. I think she's ill, from our CPA firm, our independent auditor. I'm supposed to say it very technical. My friend Kurt wrote me a script. From Eide Bailey, our independent audit firm. So the voting process, I would imagine we're pretty close to 100%. We have been every time voted online. So that was the voting process. So if you voted online, you've already cast your vote. You don't have to do anything unless you want to change your vote. If you want to change your vote, Julie, you want to wave your hand there? There's the form to change your vote. You want to change your vote, come get a form. If you've not voted yet, you can do it the old-fashioned way manually. You can vote by the paper form. But you need to go now and pick up your forms because you got to get them filled out when it's time to cast your vote. So if you're going to vote, come to the table and get your form now. Holding. Don't everybody run. You're welcome to go up and get a form. By all means. Yay. We finally have, oh man.
Going to ask for a pen.
Yes. Yeah.
Pen? Anybody have a pen? Uh-oh.
There you go.
Yes. Oh, there we go. Oh, we have a couple of voters.
I'm excited. I don't think we've had that before. By all means, anybody else want to get a form to vote? Now, you need to fill that out because we're going to be collecting them soon when the voting time comes. So, Ms. Lucerno, if you're with us, do you have a list of the shareholders entitled to vote?
Yes. The list of shareholders of record of the company as of March 31st, 2023 shows that as of that date, 3,393,574 shares of common stock were entitled to vote at the meeting. notice of the annual meeting and of the availability of the annual report of the company for the year ended December 31st, 2022, and the proxy statement for the annual meeting was sent to all shareholders of record on the record date on or about April 12th, 2023, and based on the report of the transfer agent for the company, Computershare.
Ms. Lucero, do we have a quorum?
A preliminary count of the shares represented in person or by proxy at this meeting indicates that the holders of a majority of the outstanding shares of common stock as of the record date are present at this meeting and in person or by proxy, which constitutes a quorum.
Thank you. This meeting now is officially convened. So there's two proposals for consideration today: the election of directors and the ratification of auditors. And they're fully described in the proxy that was mailed to you or that you received online. It carries all the detail. So the first proposal, the election of directors, and I'm not going to go back to the pictures, but you read them before, and I called off their names, and the board is recommending a yes for that entire slate of directors. Our bylaws do give an option to make nominations from the floor, but you had to follow the rules of the bylaws and notify us ahead of this meeting by a certain date. And since that no board members nominations were made by that date, there will be no other votes for directors, no directors running for votes today. Any discussion on that matter? The second one is the ratification of our auditors, also known as our CPA. The firm is Eide Bailly, and that's for the fiscal year 2023, and we're on a calendar year end, so through the end of the year. And the board recommends approval also of Eide Bailly as our auditor. Any discussion on that? So, Julie, what time is it?
6:18.
So as of 6:18 on May 25th, 2023, I declare the polls are open. Now's the time to deliver your paperwork if you filled it out. Well, you got to bring it back up to the table now. My lawyer said I have to follow this script. Follow the rule. He's very much a stickler on this, rightfully so. It says wait 30 seconds for manual voting. So now that everyone's had the opportunity to vote, either online, by proxy, or manually. Oh, we still got one going? Thank you, Dan. I didn't wait the full 30 seconds, Kurt. There you go. Yeah. Well, Julie, I need another time.
6:19.
So as of 6:19 on May 25th, 2023, the polls are closed. So, Ms. Lucero, we need your report.
So the report of the Inspector of Election confirms that a quorum is and has been in attendance at the meeting for all purposes, and states that with respect to proposal number 1, the 10 properly nominated candidates receiving the highest number of affirmative votes were Julie P. Dubick, James W. Ledwith, Brian Min, Jillian Murish, Lauren R. Holder, Matthew H. Ratner, Stephen D. Sefton, Vicki E. Turner, Christopher J. Woolley, and Dan C. Yates. With respect to proposal number 2, a majority of the votes cast voted to ratify the appointment of Eide Bailly LLP as the company's independent auditors for the fiscal year ending December 31st, 2023. Mr. Chairman, that concludes the report of the Inspector of Election.
I feel like I'm supposed to call it a time, but it doesn't tell me to do. So there is one more proposal that we haven't discussed yet, and it's the adjournment of formal legal portion of today's meeting. Ms. Lucero, did we get enough votes to adjourn this legal portion of the meeting?
Yes, you have received enough votes to adjourn.
So based on that affirmation, we are going to adjourn. And Julie, we need one more call.
6:21.
So as of 6:21 on May 25th, 2023, this legal portion of the meeting is adjourned. The excitement is over. So now is the fun part, the reason we're all here. We want to hear about the progress of the bank this year. But before we go there, there's one more piece of artwork by Kurt Kleider that we need to read. This is our forward-looking statement that tells us that we're not predicting the future. We don't have a crystal ball. And I'll let you take a minute to read that. You can give me a nod when it's time to go. You shouldn't have sat so close, Kurt. So Dan, I'm going to turn this over to you. And
thank you, Steve. Welcome, everyone. I'm Dan Yates, the CEO of the bank. I think most of you know me, but for those that I haven't had the chance to meet, it's a pleasure to be here tonight. I'd like to first introduce our management team, and we have a couple of new additions from a year ago. I'd like all of the members of my team to please stand, including Steve, who you've been hearing from the last few minutes. So please, if you're here, stand, everyone. Thank you. Of note, we have two new additions. We have our new CFO, Julie Glantz, who I've had the pleasure of working with many years ago at a prior institution. So Julie, it's great to have you home. And John Harrelson, who's been with us almost since day one, is our Chief Banking Officer. So if you like the revenue growth of the bank, you want to talk to John. He's in charge of sales. Welcome, John. So we've had some changes. Recently, I think many of you were able to join us at the opening of our new office in East County. And I don't know if our Odie and Tim, could you please stand and introduce yourselves somewhere? Right behind you. So we did a little bit of a team lift out. And this dynamic duo have worked together for decades in East County. They're well-known, highly respected. And we kicked off our opening, please have a seat. We kicked off our opening just about a month ago, and it was one of the biggest turnouts I've ever seen for the new opening of a branch. Quite a party, and they're off to a great start. What's interesting about our footprint, as you know, figure out my timing for this mic. What's interesting about our locations is we actually reach into Los Angeles, Orange County, Inland Empire. So physically, these are our offices, but from a geographic standpoint, we really cover Southern California. And East County is an area that has always appreciated having a physical presence. And now that we have that office open, it's exciting to see the business that's flowing in. So a great addition. So this slide's very important. I want to direct you to the red font. And this is about controlling our destiny or losing control. How many of you in this room would have predicted in December the Silicon Valley Bank and First Republic Bank might possibly be gone right now? If you raise your hand, no, you're lying. Well, I sure didn't predict that. And I would argue that they lost control. And how do I define losing control? You lose control when the FDIC closes you down. That's losing control by my definition. And if you remember, if you pay attention to some of the press clippings, the CEO of Silicon Valley Bank, a couple of days before they were shut down, announced they were going to do a capital raise. He had every intention of keeping that bank alive. Something went wrong. And the same is true of First Republic Bank. Into the last weeks of that bank, the CEO was telling their employees and their shareholders, we got this. Something went wrong. So I want to acknowledge, first and foremost, the slate of directors you just voted for, because that's where it begins. And this is where I want to start this story. It was May and June of last year. We started our planning for 2023 that early in the year. And as we looked at the headwinds, we were in the middle of beginnings of what looked like a recession. Some argued we were already in a recession. Others had a different point of view. But for sure, we saw some headwinds. So with those headwinds, we started talking about what should our strategy be. And long before we heard anything about run-on deposits or run-on banks, we made a priority for liquidity. So that was number one. And how do we define that? There's many ways we define liquidity, but one is to reduce our loan-to-deposit ratio. Now, these are terms you may not know about, but we're going to talk about these terms and why they're so important and why they're in the headlines today. In addition, we talked about should we or should we not buy bonds? Has anybody heard all the noise about banks buying bonds lately? Some who bought bonds are not so happy today with their portfolio. We hired experts. We continue to hire experts to advise us. Here's what they said. Buy bonds. They told us in 2021 and 2022, buy bonds. Lauren Polgar, Matt Ratner, stand up. I'm going to embarrass you here. So two of my board members sit on my asset liability committee. And they said, with all due respect, consultant, we think rates are going to keep going up and up and up. We don't think this is the time. I listened to my board. Have a seat. Thank you, gentlemen. It's now the fall planning session, and we started talking about a term that some of our board members wanted me to define for them. It's an important term. It's called building a fortress balance sheet. What does that mean? Well, if you think of a rope, on one end of the rope, you have profitability. And a lot of the things you're reading about now is some of the banks that lost control of their destiny focused too much attention on building profits. I love profits, but there's the other side of profits, and that is building a fortress balance sheet. That's to get to the other side of a recession so you can be opportunistic and take advantage when the headwinds are on your back. Well, how do you do that? You start by focusing on liquidity, which means we prioritize building deposits and slowing with a slight break, building loans. We're going to talk about these and how they played out as the year ahead. So we set our goals for 2023. First and foremost, Diane, are you here? Can you stand, please? In the back room. Diane Fitzgibbons is an expert in telling our story, an investor relations expert. What Diane does for us is she, first of all, helps us with our press releases, talks to potential investors and current investors, and really helps to craft and explain how we have built our bank, why we have a great story to tell to prospective shareholders. And that's important because as people know about our story, it drives value to the stock. In addition, we qualified and we applied and received permission to join the OTCQX. Think of that as where the great companies on the pink sheets finally get a chance to play. There's more disclosure, but more visibility, more credibility beyond that exchange. We believe that'll be helpful to us in the future. And as part of that, we started doing virtual investor presentations. We've done 2 so far, and we'll continue to do those each quarter. We set our goals to manage to a 1% return on assets, a 10% return on equity, and to drive our efficiency ratio to 60% or less. These are benchmarks for the best performing banks right now in our peer class. They're aspirational goals, and we think they're achievable. To do that, we also looked at this liquidity goal, and we said we're not going to chase these goals at the expense of losing deposits. Anybody see any problem with losing deposits lately? It's not worth it, right? So when faced with the challenge of earning and keeping a deposit versus having one leave, we're going to take the position to make sure that deposit stays with the bank. Our growth priorities were to favor balance sheet, deposit growth over loan growth. To what extent? We budgeted for twice the level of deposit growth to each dollar of loan growth. That's the opposite of what we've done in the last 5 years. We set a goal to reduce our loan to deposit ratio to 80%. That's a sign of liquidity, and I'm going to show you a chart in a moment as to what that means. But last year, we were close to 100%, at times over 100%. And if you go over 100%, you have to use your secondary lines of credit because what that means is you don't have enough deposits to fund your loans. That's not a good position to be in currently for most banks. So our goal was to drive that down. We wanted to outperform the market in what we pay for deposits. What does outperform mean? That means that we don't put out an ad that says we pay the highest rate of interest of any bank in the country. Come here if you want to get the highest rate, because that's a recipe to hurt your shareholders. That is not the way you build value. The way you build value in this business is you get people a reason to bank with you aside from what you pay them on interest. That doesn't mean we're not competitive. It means there are other things that are very important, such as service, such as consultative banking, which you've heard us talk about since day one, and delivering and helping our clients achieve their goals. And we believe there's value in that, and you'll see that our shareholders and our clients agree. And finally, we wanted to outperform the market in net interest income. We are in the spread business. Very simply, the business we're in is what we pay for deposits, what we earn on loans. The difference between those two is our net interest margin, and that really is in the headlines of every bank in the country right now, and everyone is looking to see if that spread is going to weaken, shrink, or widen. Our goal is to keep it around 4% right now, and that would be a bellwether result for most banks. And lastly, for our goals, we set out to do selective expansion. And in this case, I've already announced that we opened East County. We did a team lift out. Tim and Odie are part of that team. We have other members on the team. Brian Shull, I don't know if Brian's here, but we've been very effective over the years in hiring teams of very skilled bankers, and they help us grow the bank. And finally, we have an aspirational goal by our 10th anniversary, 5 years from now, to be $1 billion bank. That's going to require technology. And we've developed, and we're in the process of developing a technology roadmap, basically a strategic plan to look at what else we need to invest in to deliver the service that our clients will need as we approach the $1 billion headwinds. So why did we set these goals? How many people know the term transitory inflation? The heck is that? Well, we had COVID, we had supply chain interruptions. All we have to do is open the supply chains and inflation will be under control. Sounds simple. So what the Fed thought, it's what the Fed told us. But some of us, including our board and your management team, thought otherwise. And the Fed finally figured that out. And when the Fed figured that out, guess what happened? We saw an unprecedented, at least in my career, series of rate hikes, one after the other, at a time when banks are not used to building bond portfolios and loan portfolios when rates go up that fast, that rapidly in that shorter period of time. Why that's an issue, if you've ever dollar cost average your investments, you spread it out over time. Well, banks were out there making bets. Sorry to say, but they were making bets as to how many rate hikes there would be, how long should they go with their bond portfolio, what will the Fed do, when will inflation be under control. Those bets in many cases were wrong. I can tell you they're wrong because we have too many banks with portfolios of bonds that are underwater. Had they had a crystal ball, I'm sure they would have made different decisions at different points in time. But we're not in the business of looking at crystal balls, so we make prudent, conservative decisions. So what happened here is when the Fed did this, that put intense pressure on deposits. For the first time in many years, we were not just competing with other banks, we were competing with the U.S. government for deposits, also known as Treasury bills. Anybody here of Treasury Direct? You want the best rate? No secret, Treasury Direct right now is probably the best rate you can get. Is that good for our banking industry? No. Between March of last year and March of this year, $1 trillion of deposits left the U.S. banking system to go elsewhere. Many of those dollars went into treasuries. That left a smaller pool for the rest of us to compete for. And it was intense. So we first saw the first shoe to drop was Silvergate. We thought it was a little bit of an anomaly because we know they were a specialty bank chasing crypto, all eggs in one basket. But as soon as they announced their orderly liquidation, that's what you do right before you're forced to liquidate. That was a starting gun. Then we had Silicon Valley, Signature Bank, First Republic, We had short sellers coming to the market. A lot of talk about that. And we probably saw the first ever in our life social media driven run on a bank. Before that, I think Washington Mutual had been the fastest run on a bank. And I think that took 16 days to do what happened in Silicon Valley in a matter of minutes. How you do a run on a bank? Hold up my phone there, Steve. Wire money out. You don't run to the bank. I had somebody ask me, why do they call it a run to the bank? Because you used to have to run to the bank with your passbook savings account, right? With gray hair, we know this. Not anymore. So now we're going to have new regulations coming, and I don't know how we're going to deal with this, but I have to show the regulators how I'm going to stop social media runs on banks. We'll figure it out, but that's a new regulation coming. So we have all these new terms that are becoming everyday conversations. My favorite up here is uninsured depositors. Has anybody heard or seen articles in the paper ranking banks based on how much they have in uninsured depositors? Show me if you've seen those articles. Sounds like a bad thing, right? Well, guess what? For about 30 of my 40 years in my banking career, I've always had high percentage of uninsured deposits. Anybody want to know why? How many of you are businesses here? How many of you have more than $250 in your checking account? You may not want to share that with your neighbors, but I know this. Guess what? Businesses, and we're a business bank, keep high levels of deposits. That's not a bad thing. Not normally. But now, the media has decided that if you just focus on one metric, that's an indicator of a bank that's in trouble. And certainly the banks that went down had high levels of uninsured. But it wasn't the whole story. So we saw just in the week of March 22nd, another $172 billion outflow. At the same time this money is leaving banking, you might wonder what happened at Endeavor. Well, right around the time of this talk of contagion, we'll call it March 1st through April 30th, we increased our deposits by $39 million. Uninsured deposits. Why is it a discussion item? It's because if you are fearful of your bank's health and safety, and I don't expect any of you until you're done with tonight's session to be experts on how to read a bank balance sheet. You will by tonight, but I didn't expect you to in the past. And if you're not sure, maybe the thing to do is take your money and go to the too big to fail banks. Would you like to end up like Canada with maybe 3 or 4 banks in our country? I don't think that's good for us. But that was the messaging. Client concentrations. Silicon Valley Bank. What's the concentration? Couple hundred influencers. I thought that was something you had on TikTok. Turns out it's also true in certain banks. Influencers drive certain pools of relationships to banks. There are about 200 influencers at Silicon Valley Bank that drove the majority of their relationships. That's a concentration. Another concentration was the tech industry. That's about all they did. I already talked about Silvergate. The concentration was crypto. First Republic, concentration was affluent individuals, and most of their loans were in mortgages. Another concentration, also in a sector of the country. So I haven't heard anyone until this last few months ask me, do you have a bond portfolio? No one's ever talked to me about, do we have a bond portfolio? Why is that important? Why do banks even buy bonds? We're going to talk about that. What's the difference between realized and unrealized bond losses, and why is that important? Why is that in the news every day? And what's this thing you keep talking about, Yates, loan to deposit ratio? And then finally, why did our deposits go up and why didn't we have a run? Well, let's talk about the weekend that Silicon Valley went down. It's a Friday night. The media, the Congress is talking about what do we do? Should we insure the depositors come Monday morning or not? If you remember, there were a lot of people anxiously waiting to find out if their payrolls are going to be covered or their bank was going to go down. And we made a decision, a very important decision, to do something very strategic. And I want to start by saying one of the most difficult decisions we had to make is how to communicate with all of you and our clients. And let me tell you why that was difficult. When 3 or 4 top CEOs of banks tell you they're okay until they're not, we all get painted with the same brush. Why should you believe Dan Yates and Steve Sefton when these respectable CEOs of these very venerable banks have just told you we're fine and then they're not? There's a credibility problem. So what can we do? We decided that we were going to contact personally every single one of our clients that had uninsured deposits and let them know about a very important product called IntraFi ICS, which, by the way, pretty much every bank has. And what this product does is it insures every dollar of your deposit, every dollar. And what does it cost? Nothing. The Wall Street Journal ran an ad and said, why didn't they offer it? Indeed, why didn't they offer it? We did. And what happened in one day is our deposits went from 75% being uninsured to 75% being insured, and we became the flight to safety. Because all of a sudden, clients started calling up and bringing the money to us. And by the way, that has not stopped since March. Continues. But it's come at a price. Does anybody know or hear of a term called brokered deposits? I'm not expecting any hands to go up, but there's one. Well, I need to explain this term. It's important for you to understand it because usually brokered deposits mean that you call up a money desk and you say, I need deposits. And the person on the phone says, what are you willing to pay? And the highest rate available, the most expensive money out there is usually the cost to buy that deposit. So I'm renting the money, and that's not a relationship, by the way. That's based on rate. And if some other bank offers more money, that deposit goes out the door. And back in 2008, when we had bank failures, many of the banks that failed had a high percentage of brokered deposits. And therefore, the regulators look at that very closely and they say, you know, if you have brokered deposits and they're over a certain percentage of your balance sheet, we're concerned. But there's one thing they didn't count on, it was what happened this year. Because you see, when we put all this money into IntraFi and ICS, half of our balance sheet, half of our deposits are now in IntraFi. And under the regulations, some of those are now called brokered. But they're not the broker deposits I just described because the majority of those are not even earning interest. They're in non-interest-bearing checking accounts. They're not in there because of rate. They're in there because they want safety. So we've talked to our regulators and we said, how do you feel about this? And I will tell you that the response I've heard is you did the right thing. Good job. So you'll hear about that. You'll see it. Understanding it's important. So I told you our strategy was to prioritize liquidity. Well, how do we do? Right now, 25% of our assets are sitting in cash, basically earning about 4.59%. It wasn't that long ago when we had very little cash in our balance sheet, and we had almost all of our assets in loans. So we have built a fortress balance sheet as promised, as we strategized, and actually we have over 30% on balance sheet cash. How about that bond portfolio? We have one. Steve here likes to say we don't have one. He's being facetious. Not.
I'm rounding.
He's rounding error because it's a rounding error when you have
7 million doesn't count.
7 million to 500 million is a rounding error. But because we bought 7 million, we actually have 500,000 of unrealized losses. We would have no reason to sell those bonds and actually turn that into a realized loss. But the banks who invested in more bonds, that's a concern because that loss, that unrealized loss, affects your capital ratios. That's a problem. If you sell those banks, you realize those losses. That's a problem. If you have deposits leaving your bank and you have to redeem those bonds to take care of those cash withdrawals, those unrealized losses become real. And that's why the bond portfolio issue is getting so much attention right now. So glad to say we don't have much of a bond portfolio. In addition, we have taken our loans and the little bit of bonds we have, we pledged them against the Federal Home Loan Bank for a line of credit. A line of credit is available should we ever need to tap into it if we had a run on deposits. So if you're doing the math here, you just do simple arithmetic, you could have roughly 40% or more of deposits leave Endeavor Bank, and we have it covered between our cash and our lines of credit. When I went to banking school, we didn't run stress analysis to handle 25% runs on deposits, let alone 40. I think we're in good shape. I said our strategy was to reduce our loan to deposit ratio. This is where we've been historically. And if you'll notice, we twice here in the last couple of years, we were over 100%. Our goal was 80. We're at 82.4 as of the end of the first quarter. Almost ready to say mission accomplished. We've swept off our balance sheet into an off-balance sheet holding account over $50 million of liquidity. If we wanted to bring that back on the balance sheet, we get paid for sweeping that off. We have so much cash, we've actually given it away in a one-way sweep. We can bring that off, and we're below 80%. Mission accomplished. This is what it looks like on a graph. Now, you'll notice our assets on the left here have climbed since inception, but the climb in the first quarter of 2023 is not driven by loan growth, it's by deposit growth. And the way it looks when you have a loan-to-deposit ratio of under 100%, in the past, that would have been all blue. The little orange is our bonds. That's why Steve says zero. It's almost zero.
Looks like zero to me.
That brown, I guess that's brown. That's our cash earning over 4%, and the rest are loans. Now, I talked about pumping the brakes to some degree on loan growth. If you do the math here, if you look at the blue bar is core loans. The orange are PPP loans. PPP loans were designed to be made and forgiven, so we kind of subtract that. And if you look at that, we averaged about $100 million in loan growth the last couple of years. Well, look what happened in the first quarter. We're actually slightly down. So that is what it looks like when you pump the brakes on loans. Does that mean we're not making loans? No. We have some loans that amortize and pay off. We have a lot of our clients who are not utilizing their credit lines. And in fact, we're at about 25% usage on our credit lines when historically it's 40 to 50%. So our own borrowers who haven't gone anywhere just bringing down their credit lines. And we've actually originated quite a few loans this year, but the net of all of that looks like flat.
And we have a strong backlog.
Very strong. We're going to put that cash to work. Let me go back a page. I missed this. We hear a lot about the next shoe to drop. Like, what else can happen to our industry? Well, it seems that certain communities like San Francisco have a lot of empty office buildings. People forgot to go back to work. And those office buildings have loans on them, and they're coming up for renewal, and there's going to be some defaults. And so the big focus on what's that going to do to banks next? Well, we don't have a lot of office buildings. What do we have? C&I, what the heck is that? C&I are lines of credit, typically, or term loans to operating companies. Stands for commercial and industrial, but it's a business loan to an operating company. Most of you, if you have a loan with us, that's you.
And it's usually based at prime pricing, which is floating rate.
Correct.
Which is a nice way to price right now.
And the brown is your kissing cousin. What do I mean by that? That means these operating companies most of the time want to own their building and put their company in it. So we call that an owner-occupied real estate loan. That's about as close you can get to a business loan there is. So if there were office loans, it'd be in the small gray area, 30% of our portfolio. So now let's look at that 30%. That's what this is. That big red spike, that's the majority. Those are the owner-occupied loans that we have in our portfolio. And the rest is very diversified across different sectors. And right here, if you're paying attention, is office. About 20 million. So that if that were a bond, Steve would say we have none. We do have some, but it's a rounding error. And our average Loan to value, basically the loan amount to the appraised value is about 58% across our entire loan portfolio. This is a very conservative credit portfolio. Lauren, Chris, Jim, these are my board members that sit on loan committee. And Lauren, for those of you that know Lauren, runs one of the largest real estate portfolios in San Diego. And we don't put loans through loan committee without the green light from Lauren Polgar. This is Lauren Polgar. Good job, Lauren. Thank you. This is our typical loan. That's what it looks like. It's a building like this, 3% or less vacancy in San Diego. If you're lucky enough to buy one of these or own one of these, you're not going to find too many losing value. These are the kind of properties that hold value in San Diego. That's the majority of our loans. We have a very, very disciplined credit culture, and our strategy is to maintain a strong credit culture. Until this year, most banks that fail because of this, not runs on deposits. That hasn't happened in a long time. So you can never take your eye off the ball in credit, and I'm happy to say that our non-performing assets to total loans is 0.12% at the end of March. That's about as close to zero as you can get, 5 years running. However, we're conservative. So we're taking some of those otherwise nice profits we could report. Instead, we're building our reserves. And we've increased the percentage of our loan loss reserves to 1.6. We think that's prudent. And that's not because of any particular problem loans. We have the ability to do that based upon our belief that we're heading into recessionary winds. So we're putting that money away. Should we have problem loans in the future? Comes out of our reserves. I had a question when I first walked in tonight. It's a great question. What's happening to your non-interest-bearing deposits? Well, I would love to say they're going up. They're not. Everywhere in the country, they're going down. And that's the battle on the front lines. When interest rates are close to zero, nobody says, what rate can you give me on my money? That's not really that important to go from 0 to 0.001. But when it's 5%, most businesses are looking to get some interest on their deposits. So we have seen some migration, but at 44% at the end of March, that's pretty much best of class. And the way you get 44% is you focus on those uninsured deposits. Another way of saying that, you focus on businesses. Business banks, just by the mere nature of how they run their companies, generally have to have a certain amount in a checking account. And that's our niche. This builds franchise value. Concentrations. Do we have it all in crypto? Do we have it all in tech? No. This is a picture of where our clients are. About every industry in San Diego is represented in one of these squares, and we have no concentrations among any industry. This is our pie. This is important because at any given time in a recession, one of these sectors could go down, but we're insulated because we have diversified. And that is important in a bank, not to put all your eggs in one basket. Not sure where that got lost on a few of our peers, but it didn't get lost on this management team and this board. Pay attention to this slide and the next several, because this ties into a question I get asked by the majority of you all the time. What's going on with my stock price and why? Tell me about my stock price and why. How is it possible, Dan, that with all these press releases and all these good results, how in the world can our stock price be less than $10 a share? Well, let's talk about that. We can go back in time, and how many of you, just by show of hands, might have been at one of our pre-opening investor meetings? I'm going to test your memory. Do you remember Steve and I saying that when we started the bank, we were going to either make money or lose money? Who said we were going to make money day one? Thank you for not putting your hand up. How many remember us saying we might lose money for a couple of years? Yeah, that's how it works. You start a bank and there's startup losses like any other company. And that was our story. So let's take a look what happened. The first year we lost $6.9 million. It doesn't feel good even if it's on a piece of paper. It says we're going to do that. Then we lose a little less. And now we have deficit retained earnings of $10.2 million. So you buy at 10, you lose 10 million. Some might expect the stock to go down. We also said, and we warned most of you, I hope all of you, but I'm going to say most of you because maybe somebody missed the memo, said don't be surprised if in the first couple of years of this new bank, if your stock value goes down. I expect it to. It probably will. But guess what? It didn't. We'll talk about that. Then let's look what happens. That deficit retained earnings starts to get a little less because we start to make money in year 2020. Then in 2021, we make a pretty good profit. That deficit goes down, and finally we're above the waterline. And now we have positive retained earnings. We not only made back our startup losses, but we're in the black. That's a good thing. How does that translate into equity? Well, we started off with 24 million. Now we have 39. How did you get there? Some of it is replacing the startup losses, but we also had this thing called PPP, which gave us about 10 million to our bottom line over a couple of years. That was an unexpected windfall. Not going to come again, but we're glad it did. And it helped our community and it helped our shareholders.
Another name for that orange line is book value.
Book value, I like that. And then we had 3 capital raises. We had our initial raise, we had a secondary raise of about 8 million and change. And then finally we had our 15 million in sub debt, which we downstream from our holding company. So now we're seeing our tangible book value, thank you, Steve, going up. But you're still below $10 a share. Kind of a head scratcher. Let's look a little deeper. Net interest margin. Little pause just to remind you. This is the key to building and generating profits for a bank. And we're trying to keep it at 4%. We're almost at 4 in the first quarter. Our holding company is the orange, by the way, because a little slightly difference in accounting. But we're pretty close to 4, so we're good. We're happy with that. This is our net income stream. It's just a different way of looking at what I've already shown you. Okay, this shows you that we lost 5 million, 3 million, and we made $1.4 million, 5 million, 5.5 last year. But look at the first quarter. That is annualized. That's less than the year before. Why is that? There's a couple of reasons. First, in 2022, we had a deferred tax credit over $1 million. That's a one-time non-recurring. Can't do that every year. That'd be a nice gift. So we got to back that out. Then we have this fortress balance sheet we said we're going to build. That comes at the expense of profits. Can't have it both ways. You can't both build a fortress and maximize earnings. You got to pick your poison because 2 ends of a rope. We chose fortress. So you should not be surprised if your earnings are less this year. We're budgeting that way and we expect that. Our goal is to be here to play another day and have control of our destiny, to come out strong when this economy picks up steam, still be here. Now this is my favorite chart. My goal for all of you is to understand this chart. And when we talk next time, when you call me and say, well, about the stock price, so let's talk about this chart. This is your answer. The orange line is tangible book value. When banks are sold, does anybody know on average how much above tangible book value they tend to sell for? Somebody must know. Don, you know, you're smiling. Kevin seems like he knows. Chris got 3 times at his last bank, Square One. I've seen a range from as high, it's a Bank of Commerce here in San Diego, way back in the day, got 4 times. That's very rare, rarefied air. Probably the average is about 1.5 lately. It's certainly above 1. So you got a company that for most of our history The blue line, we were trading above book value. That's expected. Then all of a sudden, for the first time, we dropped below book value. Anybody know what value investing is? Well, yeah, but value investing generally is when you buy stocks that they're trading for less than their value. You can make a lot of money doing that. Guy named Warren Buffett's made a fortune doing that. He invests in management teams. I think you have a good one, but you judge that. So what should happen to the orange line? We've already gone through the startup period. That orange line is climbing north. It's going to continue to climb north if something happens, and that is if we continue to generate profits. That's the direction it goes in. So what happens if the blue line stays below the orange line? That means every day that happens, every quarter that goes by, we trade at a value increasingly below our worth. So Diane, out telling our story. As she's out telling her story, who is she talking to? She's talking to institutional investors. So Matt and I had a visit last year from one such investor. He said, by the way, we like your story. By the way, you didn't know this because we didn't tell you, but we bought almost 5% of your stock because we think it's a good value. And we may keep buying it. I get calls, Steve gets calls all the time from institutional investors saying, we're interested in your company. We want to talk to you. We want to buy some stock. What happens over time is if we can perform as a management team and a board and drive that orange line, either there's demand for this stock that drives it up, or someday someone's going to come knocking and say, hey, I'm Bank XYZ. I'm interested in talking. Now, I'm not interested in selling at a deep discount. Any of you? This is the worst time to sell a bank, in my opinion. That's just my opinion. But my fiduciary duty is I'll listen to anybody that puts an offer in front of us, but I'm not for sale. We're building this for long term, and my goal is to create shareholder value for all of you. And what I control, to a certain degree, is setting a strategy and executing on the strategy and keeping this bank healthy. And the rest of it is a little bit out of my control, but this tells me that we're on the right path to finally seeing the share price do what I expect it to do, and that's follow this orange line back up. So let's look at what's happened to the rest of the industry. Are we alone here? Well, look at this chart. This is showing between February 28th of this year and May 8th. The S&P was up 4.2%. Every other line there represents different sized banks in the United States. And every size of bank in our country, from the largest to the smallest, are trailing significantly to the S&P. What that says is that the investor community at large has lost confidence in banks. They've lost confidence. What does that mean? Do they think they're all going to fail? No. Confidence is also they're questioning whether or not we can control NIM, whether or not we can drive earnings, whether or not we can grow the banks. Is there going to be enough loan demand in the future to drive earnings? All comes back to earnings, expected earnings. So Steve mentioned we have a growing pipeline. We maybe overshot a little bit on that fortress balance sheet. We think this is a time to start to look at prudently making more loans. We have lots of loan opportunities, and we're starting to tap the gas a little bit, a little less on the brakes, still prudent. And as we go forward, I think we have a good chance of seeing a very strong second half of this year. We talk about the wind behind you when you're out sailing. Los Angeles, to the north, is the number one economy in the United States. Orange County is number 9, and San Diego is number 10. We operate in all three. What a great place to operate a bank in some of the strongest, most diversified economies in our nation. This is even more interesting to me. Back in 1994 in our county, we had $22 billion in deposits. We had We had dozens upon dozens of more local banks in our community. And today, we have 10, and guess who that includes? That includes Silvergate, who last I heard is liquidating. So let's call it 9. They're about done. 9 local banks and $147 billion in deposits. If anybody takes out their calculator and multiplies that times 1%, that's $1.4 billion. We want to be $1 billion in 5 years. So if we can get to $1 billion in 5 years, we don't even need 1% market share of San Diego County. That's not a Herculean task. I like the odds. So let me give you a summary of some takeaways. Liquidity. What did other banks do? They made sector bets. They made long duration bond bets, 10 years in the case of Silicon Valley. They dropped their hedges to deal with interest rate rises, otherwise known as interest rate swaps. They emphasized profits over liquidity, heavy investments in portfolios, in bond portfolios, loan to deposit ratios of over 100%, which meant that put a heavy reliance on their sales team, the teams like John leads, to go out and find deposits at the worst possible time when we're under siege and competing with treasuries. They had to use their wholesale lines of credit. Their NIM, net interest margin, was crushed. They don't have a good deposit franchise strategy. They have rates as how to attract deposits, not consultative banking. And they made very poorly timed strategic decisions, followed by select bank failures. And that's why investors, by and large, have lost confidence in our sector. What do? We focus on liquidity. We proactively reduced our level of uninsured deposits to make them less volatile and more sticky. We strategically built a loan portfolio to emphasize floating rate loans, lines of credit to businesses, so as rates rise, our spreads rise to a large degree. We've had no losses in deposits, and in fact, our deposits are up. We continue to have solid profitability. The only negative, and it's not in my control, is our stock's trading below book value for the first time. I know a few board members who understand the story even better than maybe some bankers out there, and they all focus on, Dan, when's the buying window open? When are we out of the blackout period? When can I buy? I know I like to buy, and I continue to buy, and I hope some of you continue to see confidence in this stock, because I believe we are a value stock. And with that, I'm here to take your questions, and Steve to join me. Thank you. And you stand between dessert
Kevin.
music and elsewhere, but please.
Kevin over here.
Okay, I got Kurt, and then Kevin.
Hold on. Let's
Get you again.
So when you reached out to your uninsured depositors, how many calls was that? How many people were you actually calling?
Oh gosh,
Ballpark.
we have a couple thousand clients, and I would say it probably represented maybe 400. Yeah, round numbers. Yep. Guerrilla marketing, one-on-one, calling every one of them.
all day.
Kevin, all day, all night.
Dan, you talked about the failures of management, but what does the regulation of the FDIC do? Aren't they responsible for making sure management is doing the right things? The banks?
You know, I just went to a conference, and there were a panel of regulators, and one of the things they said, and I appreciate what they said, is as you point the fingers at us, that doesn't feel good. You can be rest assured we're coming down with more regulations. Because if you're going to blame us for your management failures, we don't like that. I'm not going to blame them. Were they perfect? No. Because I sit in meetings every week in the boardroom, I can understand what it means when a regulator says you have a matter requiring immediate attention. Okay? That's not public. That's between the regulators and the management team. That happens at Endeavor. You can ask these people here, one of our values is a sense of urgency. We're on that like a fire in the house. So when I read that management took a prolonged period of time to address it, and now they want to blame the regulators for not using their powers of enforcement action to increase it from a matter requiring attention to a C and D. I know a few people here that know what a C and D looks like. I don't have anything to do with it ever again. I helped the bank turn around, and so did this handsome man right here. He's my board member. And how long did it take to get off that C and D, Kurt?
I don't want to talk about it.
Yeah, it's a bad day.
I don't want to think about it either.
But I'm not going to blame the regulators. Sorry.
Kevin,
Yeah.
that was the fastest rate rise over the shortest period of time in history. I mean, the table that the government set, administration set, whoever you want to blame, it was onerous.
But I could take any of these banks and I can, with the benefit of beautiful hindsight, isn't that wonderful? We all have hindsight when we can look back. But I, for example, could take one of those banks and say, why did you drop your hedge? What is a hedge? Anybody here own a home by chance? Do you have fire insurance? If you dropped your fire insurance, you could save some money, and you may never have a fire, and I guess you could come out looking smart because you saved some money. I'm not dropping my fire insurance. They had a hedge for rising rates. They dropped it. It was already in place. I don't know why they dropped it. I haven't heard that yet. That's not the regulators. What else you got?
You guys don't know me. I'm Don Billings. I spent my entire career in banking. I worked for the Federal Reserve, and then I worked for a company called Promontory Financial. We consulted with banks. I've seen hundreds and hundreds and hundreds of banks, and I met these gentlemen at a prior bank a long time ago, and I just want you to know why I'm invested in this bank. This was one of the most impressive presentations I've ever seen on a bank, and I can tell you from 40 years in this industry, these guys are the best bank in the business. That's not a question, but that's my personal
Thank you, Don. Appreciate it.
We'll take it.
I'm going to cry. Yes, Troy.
So the thing that surprises me that you hired consultants that are telling you to buy bonds when we were at a historically low interest rate level. I mean, I'm in the financial business. We didn't buy any bonds. We had no interest in buying bonds for all of our clients. And it's apparent to me, which is, again, surprising, that a lot of banks were falling into this trap of buying long bonds. And I mean, I just don't understand how people at a certain level would even be thinking about doing that.
So I'll give you their logic. It's not entirely wrong. They're looking at the yield curve. They're looking out long term. They sooner or later, inflation's going to get under control. We don't win. When that happens, Fed's going to bring rates back down. Don't know when. But their argument is if you wait until that day, you've missed the window. And so don't try to make the bet to predict what the Fed's going to do. Buy the bonds now, and you're basically hedging against rates coming back down someday. That's their basic argument. That's good in theory, but if you have a pretty strong indication from a lot of data points that they're not done raising rates, it's hard to justify doing it when they're advising it. But that's their theory. Is they would argue they're arguing don't make the bet either way. Just buy bonds all the time and layer them in.
And if rates don't fly up that fast, which they had never done, then you don't get hit so bad. And Don will tell you it's banking 101 to buy bonds. Every bank buys bonds. The bank that doesn't buy bond is the outlier.
It's
very unusual.
I got to share a quick story. It was it's not my second time at the rodeo. I had a bank before, started Regents, and we had all of our excess assets in Fed funds, and we had a board member in this case. Every meeting would say, Yates, You're leaving money on the table. We got to put that to work. If we don't have a loan, let's go buy some assets like bonds. So we hired a consultant. The consultant came in and he had us buy mortgage-backed securities. We're pretty good. Have you seen the movie Big Short? That's when we bought them. And I went from having a very safe balance sheet to losing millions of dollars for the first time, not on loans, but on bonds. And that wasn't a good experience for me. Still love my former board member, but it was, and by the way, smart guy, very wealthy, one of the best businessmen I know. But even smart people sometimes get it wrong. In that case, he was wrong. Being conservative with a fortress balance sheet works well, except that you're not going to be at the top of the bar of your peer group on ROA and ROE. You're not going to maximize to the nth degree your profits because you got to be perfect to do that. Perfect means I have to know exactly when the Fed's going to change their rate direction, when inflation is under control, and get that right precisely so I can place the perfect bet on bonds. And I don't have a crystal ball, so I play the prudent game of let's make sure we can be here for the long haul, deliver to our community, to our stakeholders, and make sure we control our destiny. Back to the first slide. That's the goal. Yes, sir. Mike?
What are your customers saying about the health of the economy? Are they seeing the economy slowing down? Since you have customers in all different segments of the economy, some people are saying we're going to have a hard recession. Some people say it's just going to be a mild recession. And I know it takes a while before the Fed has an impact on the economy in terms of the rates. What are you hearing from your customers as we seem to have a strong labor market, but at the same time, things might be slowing down?
The best indication of what I'm hearing is the usage on their credit lines. Because what they're really doing is husbanding cash. They're not looking to take that opportunistic jump into expanding their facilities, moving into new markets, buying equipment, buying inventory. They're cautiously waiting to get more cards turned over, to see more tea leaves, to understand where we're going. And they're hanging on to cash, keeping a lot of powder dry in the lines of credit. A lot of them are asking Steve and myself to speak to their CEO groups. And what they want us to talk about is, what do you do to prepare for a recession, which means they're thinking we're heading towards one. What do banks do in a recession? What should we prepare to see? How do we prepare to make sure we get to the other side of that if it happens? And so I would say these are not your entrepreneurs who are throwing caution to the wind. These are seasoned business professionals who have been through many cycles, and they've seen this before, because that's the kind of client we go after. And those are the clients that say, I got this. I remember the last one, the one before that. I know how to get over this. And, I wish they were borrowing their line of credit, because that would help our earnings. But I totally understand why they're not. And I can tell you, I've been doing this a long time, and I'm trying to remember when I've seen line of credit usage this low, and it's true across the nation. So the Fed is doing its job. If the job is to get businesses to help slow down the engine of growth, to bring inflation down. So it's no surprise that the tools they're using are working, not just with consumers, and that's true when you see mortgage rates go up and home buying come down, but it's also true of businesses. Rates go up, and businesses say, hey, Dan, that rate on my line of credit, that's really high. Can you do something about that? Well, not much, that NIM, right? And they don't want to borrow at 9% to buy inventory in an economic headwind. So I think, by and large, that's not to say they have any better crystal ball than any of us. Some of them may have better specific insights into their industry that they feel more optimistic. There's always exceptions. We love exceptions. But the majority are just taking it easy. Alan Sorkin, Vista's chair extraordinaire.
And Yates, 20-year friend. So we hear a lot in the papers today about the doom and gloom if we default?
Ah.
How bad do you think it would be?
I don't lose a wink of sleep at night on this issue. I try not to let the Z's go through when I read the headlines. It's political sword wrangling as it is every time this happens. It's happened so many times in my life. I just wonder, if we're going to have a little bit of pain as we play the game of chicken and blink, or somebody going to say that's probably not good. So if it goes past the deadline, there'll be some pain. It won't last very long, a day or two, and it'll cause some compromise. That's my opinion. I'm no expert on this, but I've been watching this for a long time, and this is no different. Anybody else have a different view on that? I'd love to hear that.
When Orange County went bankrupt, I told my father-in-law to take every dime and buy Orange County bonds because they discounted low. And how long was it before they came back? Orange County was sound.
Yes, sir.
Set a question. What's the bank's policy on share buybacks given the stock price? And then what can shareholders expect for dilution going forward?
So for we don't have a policy per se. The board would have to vote on that. And we haven't made any action about buying back our shares. Right now, that has become kind of a four-letter word in our industry. A lot of banks are buying back shares to try and boost their stock price. Some argue that benefits management more than shareholders. I've heard that argument, but we're not looking to do that. And the primary reason is that requires consumption of capital, and we're feeding this machine called capital to take advantage of the opportunity in the marketplace. And so when you're trying to grow a bank, if I were to do a share buyback and reduce my capital ratios, then I got to turn right back around and raise capital at probably one of the worst times to do that from a dilutive standpoint. Makes no sense to me. I wouldn't recommend it to this board. So although it might prop up share price to some degree, it come at the expense of operating our company.
Hello. My question is somewhat related to the other one here, but you mentioned that you have some institution coming to see you and talking about buying shares. What share? Are they buying it from the people that hold share now, or are you issuing new shares?
Generally, there's a little bit of float in our stock. And the way that, in fact, I was curious because there was no big transaction of 5% coming across at any time in the last several years. So I asked the same question, how'd you do that? Well, the answer is a lot of the trades happen outside of the market between market makers. A lot of times they're just buying a little bit at a time. So when you look at any given week, you might see 10,000 shares trade over a course of a month. It might be you selling, just picking on you as an example, you might sell a couple of your shares, not all of them, and you work across the room, and it's just a little bit here and there, and it aggregates.
So there has not been any dilution since
no
we started. Okay, thank you.
But not since the second round. Yeah.
Dan, any plans of another capital raise?
I would say it is probable at some point we will do that again. What form that might take, not certain. We have a lot of options. We could do another sub-debt. We could also do a common stock round. We could do a private placement with our board.
What's the pricing on sub-debt?
Today it's around 8%. It's very expensive.
I kind of joined the club early on to belong to the club and to refer clients in. Can you touch on maybe what ideal clients look like for referrals? There's a lot of people in this room. I'm sure if everybody picked up the phone tomorrow morning, you'd have a lot of phone calls, in the next week or so.
There's generally two categories of clients. Dan mentioned that we're a business bank. Operating companies that make something, distributors, wholesalers, business-to-business service, the breadth of companies across Southern California, those are our clients. Low end of 5 million in sales, up to 100 million in sales, to give you a bracket on the size. We're agnostic to industry. It's all the industries in Southern California. We are very focused, though, on organizational structure. What do I mean by that? Who are the owners? We typically are banking owner-managed companies. The person, man or woman that started the company, bootstrapped it, grew it up, made it into something. That's our client. We don't really bank very many public companies. We're not ever going to bank Apple or GM or Microsoft. We don't bank those size of companies. It's that nice place that we call the middle market where a community bank really thrives and where the owner values consultative banking that Dan mentioned. That's number one kind of client. Number two kind of client is what I call all things real estate. And it's more the who than the what. I would never call myself a hotel lender or a gas station lender or even a car wash lender, but I will tell you there's some people in that business that are our clients because the who is more important than the what. But our number one property type on the real estate side, you saw it. And well, yeah, it's funny. There's a hotel guy there, but it's the who, it's not the what. You saw that industrial building. That's the sweet spot for our client base. Why? Because a lot of that the majority of that owner managed business reside in those buildings. That's our expertise really in lending space. But we have a strong share of apartments. Really de-emphasize office. We always have. It's just not our favorite type. Never has been, and it's certainly turned out to be a good move in this market. Does that cover it?
I'm going to add one thing, Steve. I had a mentor once. I'm very competitive, as you probably might guess. And we lost a relationship to the bank, and it just bugged me. They outflanked us on price and everything else. And he said, Dan, not everyone should be our client. What do you mean? He says, well, that's what I mean. Not everyone should be our client. And what he really meant was, first and foremost, I didn't hear the word, but relationships. Relationships matter in our business because it's people that repay loans. It's people that value the consultative banking when we are trying to help a business owner, and we really do try hard to help them achieve their growth goals, overcome their business challenges. And someone who appreciates that, puts value on that, will let you make a few bucks on the deposit side, make a few bucks on the loan side. But if you get into a vendor type relationship where you're being ground down to compete for the RFP, who's going to loan me the most money, we might win that. It might even look good on our balance sheet for a while, but you're not going to build a great bank on transactions. You build great banks with people that you enjoy spending time with. A lot of you in this room are not only shareholders, you're clients, and I enjoy spending time with you. And you appreciate, and you tell me all the time, you tell Steve and I tell our team, you help me overcome this business issue, and I appreciate that. You help me figure out how to structure a deal that I was struggling with, and I appreciate that. And if that's the kind of client you are, I want you in the bank. And there are plenty of lenders out there, and they're good lenders that do transactions for a price. They can build a great business model on that. It's just not our model. So that's kind of how I look at it.
They're telling me it's time. So I'm going to invite Wendy to give us some.
By the way, thank you everyone for coming. And